As the blare of your iPhone alarm pierces the morning silence, you reluctantly wake from your slumber, grieving the fleeting hours of sleep. With a discouraged sigh, you reach for your phone, eager to grasp the pulse of the world beyond your bedroom walls. Among the notifications, an email from Amazon announces the arrival of a long-awaited package, prompting a departure from the warmth of your bed. Swiftly, you retrieve the parcel, marveling at the efficiency of overnight shipping as you cradle the Johnson & Johnson medicine within your grasp. Glancing at the clock, the relentless march of time reminds you of the impending demands of the day. With a sense of urgency, you turn to your Microsoft computer, grappling with the deluge of work emails that await your attention. Breakfast becomes a casualty of time, sacrificed in the name of punctuality as you hastily make plans to refuel at McDonald's en route to work. But amidst this morning rush, a lingering thought takes root. Every interaction, every transaction of your morning routine bears the imprint of a singular entity: BlackRock. While the name may conjure visions of a shadowy dominance and a clandestine control, the reality paints a more nuanced picture. BlackRock, with its colossal $10 trillion in assets, stands as a behemoth in the world of investment, a titan with fingers reaching into the coffers of the globe's largest corporations. Yet, despite its vast holdings, BlackRock operates not as an owner, but as a steward, managing the wealth of its clients with a deft hand. However, this stewardship is not without its contradictions, its shades of hypocrisy. For while BlackRock may preach the gospel of responsible investment and corporate governance, its own portfolio tells a different tale. A tale of investments in industries at odds with its proclaimed values. A tale of profit over principle. So, as you navigate the complexities of your morning routine, remember this: the influence of BlackRock may loom large, but its motivations, its actions, are far from black and white. Larry Fink embarked on this journey to founding BlackRock 35 years ago, wielding a vision to catapult the company from a humble $5 million entity to an $8 billion powerhouse within 5 years. His adept management of funds sourced from prestigious institutions such as pensions, university endowments, and the affluent elite solidified his status as a financial genius. Today, Fink's influence extends far beyond the boardroom, as evidenced by his esteemed positions on esteemed councils like the Council on Foreign Relations and the World Economic Forum. With the world's gaze fixed upon him, Fink stands at the precipice of a consolidation of power so formidable it could reshape the global landscape. The tumultuous events of the 2008 financial crisis proved to be a pivotal moment for BlackRock, presenting an unprecedented opportunity to seize control of faltering banks. This maneuver not only bolstered Fink's already considerable wealth, but also forged direct channels of influence with the American government. Fast forward to 2020, amidst the chaos of the burgeoning pandemic, BlackRock once again emerged as a trusted ally, summoned to safeguard the Federal Reserve from economic fallout. Such periods of uncertainty served as fertile ground for BlackRock's ascent to dominance, a testament to the adage, "With great power comes great responsibility." In a bid to align corporate conduct with societal values, BlackRock made waves in the summer of 2020 by championing the concept of environmental, social, and governance, or ESG investing. Propounding the belief that companies must serve a greater social purpose, BlackRock introduced a scoring system that rewarded diversity, environmental stewardship, and ethical governance. Despite its origins dating back to 2004, ESG investing reached unprecedented heights under BlackRock's stewardship in 2020, permeating earnings calls and sparking a surge of interest in the asset management industry. The heightened focus on the environmental and social ramifications of corporate actions heralds a paradigm shift in investor priorities, reshaping the trajectory of global commerce. So, is this a positive development? Do socially responsible companies now hold the upper hand? In an ideal world, perhaps, but as we're all too aware, the reality we inhabit falls far short of the ideal. While there's been some progress, BlackRock's embrace of environmental, social, and governance, or ESG principles, has had unintended consequences. Rather than fostering genuine change, it spurred a wave of companies engaging in practices like greenwashing, superficially presenting themselves as more sustainable, diverse, or responsible than they truly are. This phenomenon also lays bare to the hypocrisy of BlackRock itself. Despite touting its commitment to ESG investing, the company retains its status as the world's largest investor in fossil fuels and entities, profiting from conflict, all while maintaining cozy relationships with human rights violators. And BlackRock isn't alone in this duplicity. Vanguard, the second largest investment firm globally, follows a similar pattern, advocating for ESG principles while continuing to pour funds into oil, gas, and companies with questionable human rights records. Time and again, BlackRock appears to make strides towards positive change in the public eye, only to reveal a reluctance to alter its investment strategies behind closed doors, even when it could benefit society at large. Consider their stance on climate change, for example. While BlackRock acknowledges the investment risks posed by climate-related issues, its continued substantial investment in fossil fuels sends mixed signals. Although they took steps in 2021 to influence ExxonMobil's board and reduce emissions, their continued heavy investment in fossil fuels undermines the sincerity of their actions. This pattern extends to other areas, such as gun violence. While BlackRock publicly condemns such tragedies and calls for actions from gun manufacturers to protect lives, it remains the largest investor in these very companies, highlighting a glaring inconsistency in their advocacy efforts. In essence, while BlackRock and others may espouse lofty ideals, their actions often fall short of genuine commitment, leaving us to question the sincerity of their intentions. BlackRock's influence extends deep into the heart of industries that often go unnoticed by the general public. With a substantial 16% stake in Sturm Ruger and 15% in Vista Outdoor, among others, the firm claims to engage in discussions with these companies about enhancing safety measures. However, the tangible impact of these conversations remains shrouded in ambiguity. Venturing beyond American borders, BlackRock's US Aerospace and Defense Fund boasts billions invested in major weapons contractors worldwide, including heavyweight like Lockheed Martin, Raytheon, and General Dynamics. By fueling these companies with vast Pentagon contracts, BlackRock indirectly supports their involvement in global conflicts, where weapons funded by taxpayer money are used to perpetrate violence against civilians in the name of peace, as seen in Saudi Arabia's actions in Yemen. This entanglement in global conflicts raises serious concerns about BlackRock's commitments to human rights. Despite its professed dedication to environmental, social, and governance, or ESG principles, the firm's actions often prioritize financial gains over ethical considerations. For instance, its close ties with authoritarian regimes, exemplified by its access to China's mutual fund, raise questions about the nature of its dealings with such governments. Even in the aftermath of Russia's annexation of Crimea and the subsequent war in Ukraine, BlackRock's investment strategies remained largely unchanged, although it made token gestures by reconsidering some investments. Its rapid return to prominence in Russian corporations highlights its reluctance to prioritize human rights over financial interests. This pattern of behavior underscores the broader issue of how a single company amassed such immense global power and influence. The genesis of BlackRock's formidable influence lies in its adept utilization of technology. At the core of its operations are exchange-traded funds, or ETFs, which offer diversified investments to mitigate investors' risks. Instead of purchasing stock in individual companies, investors opt for a fund that encompasses stocks, commodities, and various securities. This strategic approach proved immensely lucrative for BlackRock and its stakeholders, thanks in part to the development of Aladdin, a portfolio management software introduced in 1998. Aladdin's predictive capabilities and data collection prowess enable it to assess the likelihood of investment success or failure, cementing BlackRock's position as a leading player in ETF investing. The soaring popularity of ETFs foretells a lucrative future for BlackRock, with global ETF assets projected to reach a staggering $25 trillion by 2025. However, the impact of BlackRock's dominance is already palpable, as the firm currently oversees assets equivalent to 10% of the entire global economy. The extent of BlackRock's sway is such that major corporations like Fox, Comcast, and Disney seek its counsel before making significant decisions due to its substantial ownership stakes. Alongside other behemoths like Vanguard, BlackRock holds considerable investments in tech giants such as Google, Facebook, and Amazon, fostering an environment of reduced competition. This consolidation of ownership not only limits consumer choice, but also drives up prices, as evidenced by the inflated costs of airline tickets. With BlackRock and Vanguard ranking among the top shareholders of major airline operators, there are incentives for these companies to engage in price competition, further exacerbating consumer woes. Such concentration of ownership may ultimately empower a select few individuals within investment firms to wield more influence than the executives of the companies they hold shares in, a scenario even Jack Bogle, Vanguard's founder, deems detrimental. The peril of excessive wealth concentrated in the hands of a select few poses a grave threat to the global economy. Governments hold the key to curbing this alarming trend by implementing regulatory measures aimed at curbing the unchecked influence of mega corporations. Proposed solutions include barring funds and ETFs from exercising voting rights as shareholders in companies and imposing ownership caps to limit the extent to which a single entity can dominate a company. Additionally, legislation could be enacted to restrict the level of influence investment firms wield over the companies they invest in, even when such influence is ostensibly geared towards promoting environmental, social, and governance principles. However, the urgency of implementing such measures cannot be overstated, as industry titans like BlackRock and Vanguard are poised to manage a staggering $20 trillion in assets within the next decade. This exponential growth threatens to exacerbate the existing consolidation of corporate ownership, leading to skyrocketing prices and further entrenching the dominance of mega corporations. A fundamental flaw in this system lies in the perverse incentive structure that rewards asset managers with lower fees as their assets under management swell. This creates a dangerous cycle wherein short-term gains come at the expense of long-term sustainability, both financially and socially. Regrettably, the majority of individuals lack the luxury of envisioning the long-term repercussions of their investment decisions, prioritizing immediate gratification over future consequences. BlackRock capitalizes on this short-sightedness, leveraging its perceived image as a responsible company to deflect attention from its environmental, diversity, and human rights shortcomings. Many investors remain oblivious to their indirect support of BlackRock's practices, unknowingly entrusting their funds to pension funds or endowment managed by the firm. While alternatives exist, such as smaller funds committed to ESG investing or managing one's shares independently, the convenience offered by large corporations like BlackRock often outweigh moral considerations. As public scrutiny of corporate behavior intensifies, BlackRock seeks to maintain its facade of corporate responsibility while advancing its self-serving agenda. However, consumers and investors alike bear the responsibility of scrutinizing these actions and holding corporations accountable for their discrepancies between public image and private actions. Succumbing to blind trust only perpetuates the cycle of corporate impunity, a dangerous path that mirrors the complacency that led to past economic crises. With that being said, make sure to hit that subscribe button if you enjoyed the content, and we'll see you next time.